Inflation data for September 2022 was just released, and it came in higher than expected. We've got to be expecting this by now. Everyone expected it to come in higher than expected. Why is the Fed so surprised? And they are really behind the eight ball. What does this hotter than expected inflation number mean? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Guys, we've got to expect higher than expected inflation numbers from here on out, right? I mean, that's been the case. And of course, that was the trend again when it was announced this week. Let's go back, okay? In response to shutting down the economy, the Federal Reserve took out a bazooka, using their terms, and they printed about almost $6 trillion. They reduced in an emergency announcement on a Sunday night in March of 2020. They reduced interest rates here in the U.S. to the lowest level ever, 0%. In Europe, they went negative and they've done that before, but never happened in the U.S. yet. They were reduced to 0%. And any of us that know anything about economics thought, okay, this might be necessary depending on how long things are shut down, but this is going to produce raging inflation, and it's going to have all sorts of consequences in the real economy to real people, and the Fed has no idea. They're playing with fire here, and so printed all this money. Sure enough, prices. We got out of that was the fastest recovery off of a bear market ever. It's the sharpest and fastest bear market, sharpest recovery, best 50 days in the stock market ever, best 100 days in the stock market since the Great Depression. And prices, of course, started to go up as that happened. What did the Federal Reserve say? The Federal Reserve, once again, they've got two jobs. This is it. They were buying stocks. They were trying to prop up the stock market. That's not their job. Their job is stable prices and maximum employment. Stable prices, maximum employment. So as we all started feeling inflation going up, they justified printing this much money, and they said, we're adjusting our inflation target. We now, instead of shooting for a 2% inflation target, we're looking for an average of 2% over the long term. What that means is, because they never say anything directly, the Fed doesn't, what that means is we actually want to create some inflation. We're going to try and create some inflation because we want it to be above 2% for a while. That is insane. That's insane, but that's what they did, okay? And then that was late 2020 when they made that announcement, or second half of 2020 when they made that announcement. Now we're all feeling these prices increase. Inflation is now like the hot topic. We're all being influenced by it, and yet thankfully the market was doing okay and the economy was doing okay, but still we're all struggling with it, and the Fed denies inflation, denies it. They called it transitory, which is a made-up word, that it will wane, that it will smooth out. Then as it got worse, they said, well, we didn't mean temporary, like prices would go back down, but that inflation, these higher inflations, they would level off. It won't be that bad. That's what we meant by transitory. And they just continued to deny it. And what that means, this isn't like, oh, well, someone lied to me. No, what that means is they had a policy error. They chose to continue printing money, injecting it into the system, and keep interest rates at zero after inflation, the seeds of inflation were already starting to sprout. Not just so, they sowed those in 2020. They were sprouting, and they continued to deny it. And then all of a sudden, a year ago, last fall, when inflation is significantly high, they said, maybe we've got a problem. Maybe it's not transitory. We're going to need to deal with it. But we've got the solution. We've got tools, is what they said. Okay, and that was last fall. Started creating some kind of trembling in the stock market, but we've got tools. We'll be able to solve it. And the stock market said, okay, blah, blah, blah. We haven't believed it once, especially since January, when the stock market's really gone straight down, and inflation has continued each month to surpass expectations, topping out over 9%. And just this month for September, just this week, announced for September, a increase in inflation of 0.4%, 8.2% annual inflation rate. Why is this Why is this so alarming? Inflation is a rate of change number. So several reasons why this is so alarming. Inflation is a rate of change number, and therefore, as long as prices, I think inflation goes away when prices go back down to where they were. Guys, it's not going to happen. It's not going to happen. So that's actually deflation when prices come down. Inflation goes away when today's high prices that are increased stop going higher. So gas, and gas maybe is a bad example. It's the easy one that I use. If gas prices were at 2 and they jump to 4 here in the Midwest, I know on the coast, not so fortunate. They don't need to go back down to 2 for inflation to go away. They just need to not go. They just need to not double. They just need to not go from 4 to 8. Now it's way more than gas. A lot more complicated than that. We're seeing some core commodity prices come back down. Shipping, container, those cost, freight, all those are coming back down. But still, inflation is slow moving, and it's stubborn, and it's still working its way through the system. Prices are still going up, and therefore, inflation hasn't come down as quickly as possible. However, on a year-over-year basis, unless prices still just skyrocket, we should see inflation level off, and it should eventually take care of itself. It might take a year. It might take a couple years. The Fed thought, number one, it would never happen. Then they denied it. Then they thought, well, it'll be really quick. It will go up and then it will come right back down. It's not happening. It's not happening. So that's one reason why it's important. Second reason why this is important and it matters to you is for a normal functioning economy, we need inflation and interest rates to be in parity. Otherwise, you would never take your money and loan it to someone else, meaning you would never keep it in the bank. You'd never buy bonds. In order for the economy to function normally, inflation and interest rates need to be in parity. Now, you might say, wait, they haven't been in parity since 2008. Well, I know inflation rates were minuscule. Interest rates that you got on your savings account were even smaller. So it was within rounding distance, even though they weren't exactly in parity. But when we've got inflation at 8.2%, and you're still at 2, maybe 2.5%, 3% interest on your savings account, hopefully you're there. Guys, that is way too big of a gap. Way too big of a gap. There, before the healing process can begin, and know that the stock market moves before the economy, but before the economy can heal, the Fed funds rate needs to be above inflation. That we eventually are getting there. We have to get there, okay? So, and we are still a long way off. So what this means is likely rate hikes by the Federal Reserve of 75 basis points, if not more, in November, in December, and possibly into next year. Third implication then is as interest rates go up, bond investments go down. For investing, all of us have a decision to make how much offense and how much defense we want to play. And traditionally, stocks are offense, bonds are defense. Well, as interest rates are going up at the fastest rate from the start of a hiking cycle ever, bond investments are going down. And this, with inflation coming in hotter than expected, of course, we expected it. This is going to continue to put downward pressure on bond investments, and you conservative investors, you see how painful this is. There's a flip side, though, that is potentially beneficial, and that is one, you should be able to get fixed interest rates out there that are stronger. CD rates are better, fixed investments are better, have a better interest rate. You're actually possibly able to lock in 3.5%, 4%, 4.5%, 5%, 5.5% interest rates, locking those in for a few years. So there's some flip side there. And then third, if you're owning bonds that may be below their par value, over time they will come back to that par value, even though they're trading below it right now. But yes, higher inflation means the Fed has no choice but to continue to raise interest rates, and higher interest rates mean lower bond values. And then the final obvious implication why this matters to you is as the Federal Reserve continues to see inflation at a high level, they've got to slow the economy down so they can slow inflation down. And again, that's because this is their mandate. They need to have stable prices. We don't have stable prices right now. The way to do it, and we said this at one of the all-star CFPs at KFG, one of my great friends, Bill Mock, way back over a year ago said, well, We obviously have inflation. The way to kill inflation is a recession. The Federal Reserve needs to create demand destruction so that prices no longer get bid up and actually can stabilize and come down. That means they've got to raise interest rates. They've got to be aggressive in tightening their monetary policy, which will force the economy into a slump and struggle. And the stock market, even though long term it should, these are appealing and attractive prices. Short term, the stock market needs to adapt to that potential that we're entering and into an economic slowdown. So you can see, guys, the Fed should have never played with fire here. And I'm not volunteering to be the chair or be on that committee. There's no way. Their job is impossible. However, to pretend that they weren't going to create inflation, to then say we kind of want to say then it doesn't exist, it was an enormous policy error, and we're all having to bear the brunt of it. Work with your certified financial planner. During these uncertain and unsettling times, through financial planning, you can still have clarity and confidence in the direction that you're going financially and make great decisions. There are more decisions that you can make right now, different decisions. Mortgage rates are different today. That might influence your decisions. Interest rates that you can get on your bank accounts or on CDs are different today. That might influence your decision. Bond interest rates are different. That might influence your decision. Future potential return, future returns of the stock market are now different. That may influence your decisions. All of that, you need to have a comprehensive approach to your financial life. Your CFP looking at all 6 areas of your financial life and say, okay, well, now that we've seen these changes, what adjustments, if any, do you need to make to your investment strategy, to achieving your financial goals, when to retire, that sort of stuff, all the way down to what should you do? What approach should you take towards debt, towards savings? Where should you have your savings account? Tons of decisions you've got to work with your certified financial planner on. Do so right now. With inflation being stubborn, sticking around, being higher than expected for longer than expected, this is a challenging time. Work with your CFP. If you don't have a CFP on your team, or they're just trying to help you with investments or sell you something, talk to a comprehensive financial planner or a certified financial planner that's doing comprehensive financial planning. You can find those on our team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.